Lots of people want to live to a ripe old age, but have you really thought about the financial implications of living that long? We'll talk about that this week. This is Make Better Wealth Decisions, a podcast about financial blind spots, decision making, and how the reality of higher rates, global tensions, and tariff instability impact your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto. My guest this week is Fraser Stark. He is the president of the longevity retirement platform at Purpose Investments. He holds an undergraduate business degree from the Ivy Business School at Western and an MBA from Stanford. His career has focused on innovation and change management with companies including Bain & Co. and Meta. He's a global business leader with 20 years experience driving transformative growth, solving complex problems, leveraging technology to improve lives, and strengthening Canada's evolving place in the world. He's an all-around great guy. Fraser, how are you today?
I'm great, John. Nice to be with you.
Likewise, it's great having you on. I've wanted to have you on for a while to talk about longevity, and this is one of those under-discussed problems in personal finance. Is there anything above and beyond the intro that I left out that you'd like to sort of tell people about, or should we go straight into the questions?
I think we should go straight into it, John. The longevity certainly meets that challenge that I've spent my career trying to solve. And so I look forward to getting into it with you today.
Okay, so let's begin by asking you to define and describe longevity risk. What is it, and what steps can people take to deal with living a long time?
Yeah, for sure. So first off, I think a lot of people actually misdefine longevity risk. They think of it as a very small chance of living a really long time. It's that risk in the sense that something could explode if I happen to live to be 103. Not necessarily the case. A much better way to frame longevity risk is simply think of it as the uncertainty about our lifespan. Whether as we go into retirement, we might end up living to 77, 97, or 107. There's risk there in the sense of uncertainty or variability. So that's the way I like to frame it. I think it's really helpful for then moving towards solutions to it. But just like there's risk in markets in the sense that it's uncertain what they're going to do every year. It's not only the risk of a major correction, it's really around uncertainty. So that's how I define longevity risk.
Let's take a few moments to get into the weeds a little bit about how you might deal with it. I don't want to say solve the problem, but maybe address the concerns that the problem presents.
Yeah, I mean, look, we're faced with uncertainty here, and I think most of us recognize that going into retirement, and we do take steps to solve it for the most part. There's a couple of different paths. You know, the main lever that people have, or one of the primary levers or dials, is how much they spend each year. And so, the main thing you can do when you're sitting on a sum of money and you're looking at an uncertain number of years remaining is to spend at a responsible level. And that is what most people do. Now, there's always the approach of solve this with hope and simply have the money wind down by the time you're 90 or 95 or some specific age. There are risks to that. So you're replacing one risk with another. But for most people, they solve it by spending at a responsible level that essentially sees them not decumulate and not burn through their nest egg during those retirement years.
And it's one of those things where you have to match assets and liabilities. And one of the problems that financial planners have is that there are some people, it needs to be said, that overplan and underspend and die with a 7-digit estate or an 8-digit estate because they've been frugal all their lives. But the more likely problem is what you just described. So perhaps we can put some numbers around this. Do you have maybe some sense of how long people are living in Canada and what people's expectations are with regard to what a lifespan in retirement will look like, both in terms of expenses and in terms of length?
Yeah, for sure. So to start off with some numbers, the average 65-year-old Canadian, and I'll speak in round numbers here. I mean, you can work with a planner or an actuary to get into specific, but the average 65-year-old Canadian can expect on average and in the median to live to about age 87. So they have about 22 years of expected lifespan left. The challenge is that because that's the median, it means half of people will surpass that age. So it actually doesn't serve much value as a planning tool. To know that it's 87 is not a great point to build an income plan out to. Often you hear about people throwing numbers like 90 or increasing 95 out as an age to plan to. But here's the scary number. Is that, and I'll speak for women here who typically live a little bit longer than men, but a 65-year-old woman has a 10% chance of living to age 100. and some amount of time beyond, typically not too much. But most people have no concept of that. Even the first time I heard it, I thought that number might be wrong, but it is very high. That's inconsistent with our experience. Few of us have parents or grandparents living to that level, but a lot has changed. A lot has changed about medicine. A lot has changed about lifestyle. And increasingly, people are living a very long time. But again, the uncertainty or variability of it is what makes it so challenging. So while some people will live to be 100 plus, and it's not a tiny number, the majority of us, well, on average, we will live to be about 87 if we're going into retirement now. And unfortunately, some people won't make it that far. I mean, some people do pass away a few years into retirement. So all of these possible outcomes need to be factored in when developing a retirement income plan. So retirees are optimizing with their advisors in the face of multiple uncertainties. And it's that intersection of several uncertainties that makes it a uniquely challenging time. We have market uncertainty. We have lifespan uncertainty. We also have inflation uncertainty, which you can think of as affecting our real rate of return. Even beyond inflation and cost of living, there's also a lot of uncertainty about what those years of our lives are going to look like. When I'm 90 years old, will I still be buying golf balls and golf memberships and airplane tickets? Or will I need a lot of nursing care and perhaps equipment to help make my home able to accommodate me? I don't know. I also don't know if I'll be in a facility or living at home. So all of these uncertainties intersect, making it a really challenging time.
Listening to you speak, I thought of two things. First off, my wife has done a lot to get me to think more about longevity and lifestyle so that we can have a longer life. And she just sent me a podcast this past week where there are now experts saying that it's entirely possible that someone who is already alive and on the earth today will at one point live to be 150. That's a thought that is inspirational to some, but it could also be terrifying because how will we pay for this? And so it's not even science fiction anymore. We now have, credible PhD and doctors and people that are doing research saying that this is now not beyond the realm of possibility that we might live to be 150. Someone somewhere alive today will live that long. So that's one thing. The other thing that I wanted to mention listening to you speak was that there are a lot of people that give financial advice that are financial planners. And FP Canada, the people who confer the CFP mark, put out assumptions guidelines every year in April. And those guidelines talk about what you're saying. So if people are doing plans, those plans should take into account a reasonable expectation of life expectancy. And they're now saying 95 is the appropriate age to plan to. A couple of things that strike me as being notable is that if the over-under is age 87 for one person, then if there's a couple, a husband and wife, then the odds of one of them living to, say, age 90 is pretty close to 50-50. If it's 50-50 for either of them, obviously there's a chance that at least one of them will live even longer still. And that's one consideration. And the other thing is, I don't know how many people are actually, when they do their financial plans, how many financial plans actually go out that far. And I'm not sure what the number is. I would be surprised if people had really come to terms with, how long people will live. And specifically, I suppose, how long people will live in retirement. When I started in the business more than 30 years ago, because I'm that old, people were, retiring at 65. And a lot of people, my parents' age, were expected to only live to be 72. It was only a 7-year lifetime in retirement. Well, now it's tripled. You're still retiring at the same age, or maybe even a couple of years sooner, but we're living much, much longer. And so the amount of money that you need to save up has to last so much longer, which means the pool of capital that you have to save up while you're working has to be that much larger. And I don't know how many people have really thought about it. They'll say, oh yeah, I'm going to retire because, mom had, dad had, and they'll think that whatever amount they had, if they adjust for inflation, that's the amount they need. But they forgot that mom or dad had the good sense to die when they were 74 and they're going to live to be 84 or 94. The one last thing that I wanted to mention is that a lot of people who work with a financial planner tend to be fairly well-to-do, and the well-to-do tend to live longer. So if the actuarial average is, say, 87 for society as a whole, the people that are wealthier tend to take better care of themselves, have a better diet, have better social support networks. And as a result of that, they also, by virtue of their lifestyle, self-select into being part of a cohort that is disproportionately likely to live longer. And I don't know how many people are thinking about that.
Right. Unfortunately, many of them have the assets, to your point, John, to fund it, even if they do live to be, considerably older than the average or well beyond. If you think about the way most people address this, it is, as I said in the beginning, it's by spending conservatively, right? So there's the famous 4% rule, which was empirically tested back in the 90s. And while not everyone follows that precisely, some version of it, some conservative spending level, if you think about what it's doing, the 4% rule is really letting you spend your real returns. And what that means is if you set it into retirement with $2 million and spend 80,000, so 4% of the 2 million, and then raise that each year with inflation, your portfolio balance is likely growing over time. It's holding its real value because you're spending approximately the real gains. So that works even if, heaven forbid, someone does live to be 150, in theory, that person should be able to maintain that starting spend level throughout their full retirement. However, that doesn't work for everyone, right? Obviously, that approach leaves a pretty big estate behind. And if that's a big consideration, as it is for many people, that's a wonderful thing. But to your point, if not everyone has those means, maybe someone's not starting with $2 million, they're starting with $500,000. So suddenly 4% is only $20,000 a year. And everyone has a different situation in terms of how they value leaving money behind when they pass away. I'm not thinking about one person, I'm thinking about a couple. To your point on joint longevity, it's what happens when the second person in a couple, where people are planning for retirement as a pair, what happens when they pass away? Is it important that the real value of that initial retirement nest egg is left to the next of kin? It's wonderful if it is. But if that means a level of spending that doesn't lead to having the retirement of your dreams, or frankly, a comfortable retirement, then that's where it becomes a problem. And so, I think we'll talk about longevity risk pooling, but for some people, some aspect of longevity risk pooling can be an effective way to address that, where their estate need is not as high, their bequest need, and in fact, their need for sustainable income in retirement is high.
Before we get into risk pooling, I wanted to offer my thoughts on the so-called 4% rule, but it's actually more of a rule of thumb than it is an actual rule. There's no mathematical. So the researcher that came up with the study is named Bill Bengen. There are many people who have since come out to say, actually, Bill, you used U.S. data and the U.S. market has done better than other parts of the world. And if you're using a balanced portfolio with assets that are outside of the U.S., chances are you're not going to do as well. And even if you were going to use assets that are in the U.S., there's this notion of a reversion to the mean, and the U.S. market has done exceedingly well relative to other markets over the past 8 or 10 years, and that's unlikely to persist. And so the data set that Bengen used to say 4% is likely to be sustainable is based on assumptions and an experience that many people would say is unlikely to be replicated going forward. And as a result, a lot of people are saying that the real number is actually even less than 3% and not 4% indexed to inflation. And I think that becomes even truer as you take into account longevity. So you need to have a pretty decent sized nest egg in order to get this to work for you. If in fact you live the way actuaries, or for as long as actuaries think you're likely to live. All right. Yeah. Let's move on to risk pooling, because you did mention that, and that is what I was going to ask about next. So I wonder if you can compare and contrast two different approaches to dealing with longevity risk. One is to buy an annuity, and the other is to buy a product such as the one that you've pioneered at your firm at Purpose with regard to the concept of risk pooling by having different people of the same age cohort share the risk, but as long as you live a long time, you're not going to be able to outlive your money. So basically pensionizing the nest egg that you have to find a way to have a pool of capital that you can't outlive. So maybe can you compare and contrast those two approaches?
Yeah. But before I do, John, let me start by, I just wanted to make sure we understand risk pooling exists. We do it in our lives today. It's what an insurance product does. If I buy car insurance, as I think we're all obligated to by the Ministry of Transportation, I am pooling my risk of being in an accident. That's the uncertainty or variability in what my annual accident costs will be. Unfortunately, I've never been in an accident, but it could happen and it'd be quite expensive. And so rather than dealing with a really negative consequence if that liability does emerge, I and all other drivers in this country have car insurance. Likewise, the risk that my house burns down, that would be a financial hit I could not afford to simply rebuild. It would fundamentally change my lifestyle, put it mildly. And so I insure that risk. Those are cases where we're risk pool. Through people who have a defined benefit pension plan, or anyone who has a CPP in Canada, because those are programs that last as long as we're alive and with different versions and flavors, they are risk pooling our longevity risk. So we all have some degree of it in our lives, both with things other than longevity risk and then longevity risk with some of these government benefit programs. I think for people going through or entering retirement with a decent nest egg of financial assets, the idea of applying longevity risk pooling to a greater portion of that than they already have through CPP can make sense. And annuities are a wonderful product. They effectively transfer your personal longevity risk to an insurance company's balance sheet. The insurance company doesn't know what's going to happen with any one annuitant, but they do know what is likely to happen to a pool of them. And so the insurance company is able to take that on responsibly. They commit to making a payment, typically a flat payment for the rest of your natural life. And so they're also taking on market risk. And that's important. It's wonderful. It comes as a guarantee. People love the term guarantees in Canada, especially. We find that a very attractive proposition. And guarantees are wonderful. They do come at a cost. And so just like I don't have my entire portfolio in GICs or interest-bearing accounts, I have some, but it's a small fraction. I choose to take on risk in my portfolio because I know that by having risk and variability year to year in my portfolio, it's almost a certainty that in the long run, I'll do better. There's very few scenarios where over the next 15 or 20 years, the GIC proves to be the best investment to make. And so what we've done with our longevity pension fund is exactly that. We've created a balanced portfolio. It's a pension style portfolio, stocks and bonds and commodities and other kind of inflation hedging assets, those sorts of things. And we've embedded longevity risk pooling into it through the redemption structure. And so we give lots of flexibility for people to access back their unpaid capital, effectively the amount of money they put in that haven't yet received back as monthly income. And so it's like an annuity, but it's not an insurance product. We're not regulated by insurers. It's not a guaranteed amount. We choose to invest that conservatively, but there is risk year to year that it goes up or down, and our income is adjusted each year. And so we think this is an important addition to the option set that a Canadian is facing. When we spoke with people about what they liked and didn't like about annuities, they love the idea that it will last as long as they are alive. They didn't love the fact that they couldn't access any of their capital typically while they're living. And they didn't like the fact that the payment levels aren't quite as high because the insurance company needs to take on that risk and they need to be paid for doing so. So those are two products that address it, and they can be thought of in a similar way to a balanced portfolio of stocks and bonds and a more secure sort of interest-bearing, effectively guaranteed product.
This is another opportunity to put your toe in the water with regard to financial planning. One of the things that I have said on a number of occasions is because of the fact that Canadians are living so long, most people, if you're in good health, should defer your CPP for as long as possible, which usually means the month that you turn 70, you get an extra 0.7% per month every month after your 65th birthday. That works out to, you do the math, 8.4% per year and 42% more. So if you're, getting $10,000 at age 65, you're getting $14,200 at age 70 in CPP benefits. And the over under in terms of break even is typically at around age 81. So you end up getting more money if you live to be 81 or more, which is disproportionately a very, very large majority of Canadians that are in good health at age 65 live to be over 81. And yet, What percentage of Canadians actually wait until they're 70 when they take CPP? About 1%. That's all.
Right.
Which proves the point that I would make that I think you would agree with, that longevity risk is not only misunderstood, but going largely unaddressed in the Canadian marketplace because people are they're planning based on old assumptions and old worldviews, and they're not really thinking things through.
There's a great way, John, of framing the decision around when to take CPP. And it's think of it as whatever spending you're going to do from age 60 to 70, because you can pull it forward as well as push it later, right? So the 65 to 70 is one comparison, but the 60 to 70 is another. And I think the numbers are even starker that way. But the way to frame it is whatever spending you are going to do, that instead of funding through CPP checks, you find out of your personal financial assets, you can think of that as buying a lifetime pension, right? By spending out of your account, you're buying it. And I won't say it always makes sense. I think to be fair and accurate, we need to say there are cases where it doesn't make sense to defer it. But I think, to your point, if only 1% of people are deferring all the way to 70, it's likely driven by, I think some faulty reasoning, unfortunately, where, rumors about the long-term solvency of CPP or simply a sense of, government has taken this money and I want it back. These are not the right ways to make the decision. It's a highly secure program And I think when you think about when you frame it as the ability to buy a lifetime pension, you'll have less money in the bank the day you turn 70 than you would have. But now you've got a much higher income to cover. I mean, who knows what the rest of your life entails and what that spending could do to make it comfortable and enjoyable.
And I'll let out a little secret here that there are a number of people in the financial planning community who are of the view that there's a misplaced agency on the part of many financial planners in Canada, that the facts are, as we've just discussed over the past 15 minutes, but the reality is that financial planners tend to make money based on the amount of money they're managing. And if they can get people to leave more money in their RIF and take that money out of CPP to supplement their lifestyle somewhere between age 60 and 70, then that will be accretive to the financial planner's bottom line, even though it is brazenly contrary to the interests of the people they're supportedly trying to serve. There are things in this system that could very well work at cross purposes. And one of the reasons I tell people to make better wealth decisions is that you need to look under the hood and check the motives and see if you can understand what's actually getting people to do what they're doing. Could I ask you also to weigh in, since we're talking about financial planning considerations? We're at the point right now where Canadians have to convert their RSP to a RIF at age 71. Have you given some thought to what you think might work well going forward? I know there are some people who are talking about either A, reducing the amount of money that's required to come out of a RIF when you start making withdrawals, or B, deferring the date at which you may need to start making withdrawals, say to age 73. Do you have any thoughts on either of those?
Yeah, I mean, when an investor faces choices on the conversion from an RSP to a RIF, I think, it's going to depend on their personal financial circumstances, of course, and probably a great decision to work with a planner or advisor on. Oftentimes deferring that out as far as possible, just like the decision to take CPP can make sense. These structures that allow compounding returns without taxation are valuable and should generally be used as long as possible. I think where the consideration gets a little more complicated is around tax brackets, and where it can bump someone's future payments up or cause clawbacks to OAS or GIS. So that's why it really is a personal decision. But speaking for myself, I plan to defer both CPP and that RIF conversion as late as possible. And I think generally that should probably be the default, unless a look at your own personal circumstances dictates otherwise. The policy question is a really complex one. There's passionate people on all sides of this. When I look at it, I'm reminded of a couple of things. One is the RIF minimum withdrawals actually end up driving a lot of people's spending decisions, which is an interesting behavioral psychology, behavioral economics aspect of this, that we talked earlier about how people often retire with large sums. Retired investors struggle to spend capital. And so whether it's because they're generating income and yield in their portfolio and that's coming through to them and being dropped into their account, or whether the CRA mandates that they have to take the money out, there's an interesting aspect to this that it is driving spending behavior. But that's where it then becomes interesting that, starting just above 5%, but ultimately getting to 20% to someone, I think it's once you're 95, it hits 20%. Where I would look most closely is that, once that mandated withdrawal gets above 10%, I think what you're doing is you're forcing someone to decumulate, take money out of the program. And the portfolio is likely not generating 10+% returns consistently, perhaps some years, but not consistently. And so, I think telling a 95-year-old who might end up living to be 106, you just don't know at that point. And when you redo the math for people who are 95, what are their chances of living to 100? Well, guess what? Now it's much higher than that 10% they faced 30 years earlier. And so these are the ways I would look at it. It's the later years where the withdrawal levels get really high. The final thing I'll say though is we shouldn't confuse a RIF withdrawal rate from what we need to spend. You can absolutely take money out of the RIF. That is a tax question between the CRA and each individual taxpayer. It doesn't mean you're forced to spend it. You can put it into non-registered assets. You can put it into a TFSA if you have the room. It's a different question. So I think a lot of people sort of squint at it and say, why do I have to take all this money out? I don't need that money each year. The spending question is a different one than the withdrawal question. And I think when you separate those decisions, it can make a little bit more sense. We know the government wants their share of our income over time. That's not going to change for all of time. That's why I look at the policy question.
Pleasure speaking with you because there aren't a lot of people that I consider to be soulmates because I also intend to defer my CPP until I'm 70 and defer my my RSP conversion to a RIF until the last possible moment. So there aren't a lot of people that I run into that are of like mind. So it's refreshing to find someone who thinks that way. I want to thank you for your time today, Fraser. And before we go, there's one question that I always ask my guests, and that is the podcast is called Make Better Wealth Decisions. If it was up to you, what advice would you give to listeners to help them make better wealth decisions?
That's a big question, John. I think it ties to what we've talked about here, and it's embrace everything that retirement has. It is more than a financial question. I've approached it from the financial angle. You're a fellow traveler on this road of helping people think about it financially. It is more than that. It can be such an interesting chapter of life. Show some empathy to your future self. We sometimes don't think of the version of us 30 years down the road. We don't know what that person's going to be like. We don't know what they're going to care about. And I think sometimes it makes us form questionable decisions about their best interests. So have some empathy for your future self, embrace what retirement can bring. And I think if you do that, you'll make really wise decisions.
Thank you so much for your time today, Fraser. It's been a real pleasure.
Thanks, John. It's been nice being here.
This podcast is not to be construed as offering specific investment advice. Please consult a qualified advisor before acting. My books, Stand Up to the Financial Services Industry and Bullshift, are available online. If you'd like to meet to discuss how the topics in this podcast affect you directly, please visit my website.